Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we're coming to you live from the CNBC-TV18 Motilal Oswal studios. Markets looking a little better sometimes, look a little worse off. That's the kind of phase we are in. What after yesterday's 200-point bump today, of course, is also weekly expiry. So a fair bit of action-packed next few hours coming up. I'm Prashant. With me, my colleagues Reema and Nigel. Guys, hi. Morning.
Hi, morning. The only thing is that crude is again inching back, right? Yesterday it was at $100 per barrel. Today, this morning, it's at $103 per barrel. But Asia is firm. Across the board, you've got gains of 1.5 to 2%.
Well, that's right, guys. And we're going to be tracking the market action all through the day. But for me, it's a special day because it's my wife's birthday. And we talk about buying the dip. I'm happy that, I'm lucky to have my life partner who's been buying me on the dip for very, very long. And in good, bad times. So happy birthday, Navneet, and wishing you a cracker. We'll join you later today. So we get back to the market action, but need to take advantage of where you're sitting today.
Enjoy the day.
Thank you so much.
Well, let's just quickly take a quick look at what you need to know as we begin this session. You've got oil, which is basically back above the $102 barrel mark. In Asia. And I say it's back above because it was back under $100 last night. I mean, actually, oil prices sold off 3%. By US market close time, but it's back above 102. Now, last night, S&P was up 1% and the Nasdaq was up about 1.25%. This is a big deal because, I think the S&P is down for about 6 out of the last 8 trading sessions or something. So, even a 1% pop is being noticed. Market breadth was strong. It was not as if it was led by this or that. 75% of S&P 500 finishing in the green last night. And some of the things which went one way went the other way last night. So the 10-year yield has been continuously inching higher. Bond yields across the developed market have inched higher in inflation fears. So the 10-year was down 5 basis points. Dollar index was down 0.5%. It's inched up a little bit this morning to about, I think, back above 99.9 plus. But, this is the setup, what US kind of sort of reacted to last night. Now, you'd wonder if things have changed, if things are looking a little bit better. And the short answer is not really. And I'll tell you why, just a couple of reasons. So estimated oil flows through the Strait of Hormuz is still down 97% compared to normal. That is point number one. So very little oil is passing through the strait. The market is seemingly focused on the start of this IEA strategic oil releases, right? The IEA said they're going to push out 400 million barrels of oil. Timeline was unclear, but more and more demand that this be done immediately because there is a physical shortage which has to be met. Iran also signaled some willingness to permit some carriers, some tankers through the Strait of Hormuz, specifically India and China. All right, if you look at who buys the maximum amount of oil which comes out of there, comes through the Strait of Hormuz, China single-handedly is about 35% of the oil. Number 2 is India. And of course, there's other countries in Asia which also are dependent on that. And it looks like Iran is willing to sort of, let some of these tankers pass through, specifically Indian and Chinese. Will that make a difference to the price of oil is the question, and that we can come to a little later. Now, statements from President Trump, lots of statements, will play out some sound bites, but they are largely sort of, focused on trying to get the Strait of Hormuz going once again, operational once again. He's requesting other countries to join the effort, but so far what we've heard, of course, is it's a no. Lots of countries, 5, 6 large countries have all basically declined. Some are saying we're considering, but no one has said yes, that we're going to join a US naval effort to escort these tankers through the strait. And I think that is quite telling. Now, Trump essentially has requested China to delay the meeting with Chinese President Xi. He says, well, he wants to stay in Washington to oversee the war effort. So that was something else. Now, NVIDIA's annual GPU technology conference happened last night. And Jensen Huang, the CEO of NVIDIA, essentially says that he expects revenues for NVIDIA to double to $1 trillion by 2027. That's a big number. I mean, it's I think 99% of the time at these conferences, Mr. Huang and, of course, NVIDIA have always sounded extremely exuberant. I mean, look at the stock. It was about 1.5% higher. So it was not as if it ripped higher. I think that is largely because the market expected them to sort of post a very, very rosy kind of a picture out there. I'll just leave you with some levels here. So we are in a downward sloping channel. I mean, we'll try and put that chart up, which tells you visually what's happening, right? It's you go and we bounce around in the downward sloping channel for a while. At the upper end, the lower end, the upper end, the lower end, and now we are moving back up again. So the upper end of the channel resistance is 23,590. That's the first level which the Nifty's got to take out, and then we'll talk about the levels like 24,000. If this fails, if you're not able to get to 23,590. Then you basically fall back down to the lower end of the channel, and that comes in at about 22,500 or so. So that, to my mind, are the two numbers to watch out for. 22,550 on the downside, 23,590 on the upside as far as the Nifty is concerned. Nifty Bank, we can talk a little later. Today, as I said, is also expiry. Remember one thing, and I said this yesterday morning as well, because the market is so light, it's, these rips higher, these rips lower, these gaps higher, these gaps lower are going to come very easy. And they're going to be a little indiscriminate. That's the kind of trading environment we're in. Too much news flow. No one knows what's really going on. No one knows what's the end going to look like to this war. So it's going to happen. And I think we saw a trailer of that yesterday. Starting 2:20 yesterday afternoon, the market actually went up almost about 300 points. By close, it gave up a little bit of those gains. The GIFT Nifty is indicative of what the kind of open that we're in. There perhaps will be some covering ahead of that expiry today, but we'll see if these gains last as we begin a fresh new trading session. The F&O positioning, how is it looking like? Nigel has walked across to the wall. Nigel, take it away.
Well, that's right. The GIFT Nifty suggesting an 80-point bump up, and put that together with yesterday's bounce. If we can end with the 80 to around 100-point rally by the end of today on weekly expiry, the bulls will be very, very happy. Well, there was the bounce that came about yesterday, but it came about from oversold levels. Though the risk to the downside is still very much alive, going by the data points, since there is no de-escalation as of now. A short covering bounce, though, was evident. The key indices, they rallied big time from the lows of the day, and the open interest on both of them was actually lower. Another positive was that the India VIX, that's facing some kind of resistance at around the 23-odd mark. And the bulls will hope that this 25-odd mark is not breached. Yesterday, even at the low point of the day, the India VIX was more or less flattish, or it was trading in the red. Normally, that's a sign that things could actually be reversing, just in terms of an intraday basis, and we had spotted that at around 10:30 a.m. yesterday. So you don't want the VIX to get to around that 25-odd mark. Though we did see a bit of a bounce, the FIs, they continue the aggressive selling ways. While there were some signs of a bit of, a covering on index futures. So in the cash market, they sold. There was covering that we saw on index futures. Well, there was some long addition that we saw on stock futures as well. So the FI, the action in the F&O market should come up for you. Clearly covering on index and some long addition is what we saw on stock futures. The short positioning, though, is very, very aggressive still. 88% of the positioning on the short side. In absolute terms, it's around 2.5 lakh contracts. While there were some calls that were written earlier, well, yesterday, those call writers, they packed up their bags. So there was some unwinding that we saw on those calls that were written earlier. And, well, there was some put writing that we saw in trade yesterday. Moving to the options data, though, there was writing at two strikes. 23,500 call, 23,100 put. So on weekly expiry, you'll want the Nifty and you'll want the Nifty Bank to make a higher high as well as a higher low. So by the end of today, you'll actually want a higher high and you'll want the low of the day to get defended. Similar is the case with the Nifty Bank, and I think this holds the key. If you can get gradually to around the 55,000 odd mark, the bulls will feel that from these oversold levels, that bounce can extend a little bit. So the risk to the downside is still alive, but I think a relief rally is something that we could still be bracing for, provided yesterday's low does hold out. Another data point came in from Samco Securities that, normally when you see a 5% pullback on the Nifty in a particular week, the next week actually isn't that bad. That's what history suggests. So you'll be hoping for something like that to play out this time around as well. That's the data point coming in from Samco Securities. Whenever the markets have corrected by 5% in a single week, probability of a bounce back in the following week is there. So just want to clutch onto that. But Brent crude prices not going to that $110, $120 per barrel mark, that's the risk out there. So we'll have to keep an eye out on that front.
Well, at least the week started off well, with the markets gaining over 1% on Monday and a sharp 450-point recovery from the intraday lows. But let's get to the latest Trump-related developments. Speaking to reporters at the White House, Trump offered an optimistic but vague timeline for the end of the conflict, which is already in its third week. President Donald Trump said the war with Iran could end soon. But he also addressed Iran's retaliatory attacks across West Asia following February 28th US-Israeli strikes. He said intelligence officials did not anticipate such retaliatory attacks across the neighbors. Trump also reiterated his appeals for help from other nations to secure the Strait of Hormuz, saying that Iran was nearly obliterated even as the war kept roiling oil markets and global shipping. Listen in.
Greatest experts, nobody thought they were going to hit. They were, I wouldn't say friendly countries, they were like neutral, they lived with them for years. Peter, they were going to take over the Middle East. They were going to knock out Israel with their nuclear weapon. But after we knocked out their nuclear potential weapon, they started building missiles, thousands and thousands of missiles. And they were going to do it with missiles while they developed. These are sick people. While they developed nuclear, somehow they were going to start at a different site, because that site was, you saw the site, the mountain. They were going to go into a certain area, which we know exactly where it is, and they were going to do that. And it's incredible what we've done. We strongly encourage the other nations to get involved with us and get involved quickly and with great enthusiasm. I have that from a number of them, and I'd like to say their names, but frankly, I don't know if they would want me to or not, because maybe they don't want to be targeted. But I say, wouldn't matter if you're targeted or not, because this is a paper tiger that we're dealing with now. It wasn't a paper tiger 2 weeks ago. It's a paper tiger now.
Okay, well, the other one, of course, was his proposed visit to China to meet President Xi in China, and Trump essentially saying that he's requested to delay the summit with his counterpart for about a month or so, citing the need to oversee the Iran war and sort of stay in Washington for now. Listen in.
We're speaking to China. I'd love to, but because of the war, I want to be here. I have to be here, I feel. And so we've requested that we delay it a month or so, and I'm looking forward to being with them. We have a very good relationship. But because of the war, there's no tricks to it either. It's not like, oh, gee, I'm waiting. It's very simple. We got a war going on. I think it's important that I be here. Yeah? So it could be that we delay it a little bit. Not much.
Well, meanwhile, the U.S. Treasury Secretary Scott Bessent tells CNBC that more and more ships are going through the Strait of Hormuz, and many countries, including India, are using the oil. Adds that the administration is not in favor of further easing of sanctions against Russia. Let's listen in.
We are seeing more and more the fuel ships start to go through. The Iranian ships have been getting out already, and we've let that happen to supply the rest of the world. We've seen Indian ships go out now, so the Indians who rely very heavily on Gulf oil. We believe some Chinese ships have gone out. So that should start ramping up before there are any the flotillas or protective armadas in the Gulf. So we think that there will be a natural opening that the Iranians are letting out, and for now we're fine with that. We want the world to be well supplied. Which is more? If oil spiked to $150, but Putin was getting 70% of that, or oil stays at 95 to 100, where's he getting more money? If it spikes to 150. So roughly his coffers are unchanged, and that whether a couple of billion more, a lot of money in the real world, but in terms of the Russian Federation, costs him about $2 billion a day to run the government. Mm-hmm. So the idea is, as soon as the conflict is over, and the markets are well supplied, to go back. And again, it is a short-term window for oil on the water. We believe that will be consumed very quickly. And Brent, the other important thing to know is that oil was going to China. They were going to consume it anyway. It was just backed up. And so by unsanctioning it, it can go to Malaysia, Singapore, India, The Indians have bought quite a bit.
Let's just get a quick check on Asia this morning. The markets which are flying off the shelves are the Korean markets. That's up 2.5–3%. Taiwan is super strong, up 2%. You've got green, 1.3% up on Hang Seng too. Shanghai's opened up in the green. But the big driver for Taiwan and Kospi are the memory makers, SK Hynix, Samsung Electronics. They've gained 3–4%. Taiwan's TSMC also in focus. This is after NVIDIA CEO Jensen Huang yesterday spoke about a $1 trillion of an AI opportunity. And what's even more incredible, that he went on to say that even at this scale, we are going to be short. So that's powering the gains in Taiwan and Kospi this morning. GIFT Nifty is suggesting an implied positive open. David Chow, global market strategist, Asia Pacific at Invesco, is now joining in. David, great to have you. Thank you very much for joining in. First, about markets and economies. Oil prices still stubbornly above that $100 per barrel mark. How severe do you see the current risks from the Iran conflict, the Gulf disruptions with respect to Strait of Hormuz on the Asian economies, inflation and markets? Have you changed your assessment for this year?
Well, I'd like to say that it's impossible to predict the geopolitical outcome. But what we can do is run scenario analysis, and we look at current supply demand dynamics and also global inventories as well. So if I assume that the current Strait of Hormuz is closed, but still around half of the supply of oil out of the Middle East it still flows either through the east-west line in Saudi Arabia or Iranian oil or the G7 increase in output. Let's just say half of that oil is disrupted, and I look at global inventory levels. If the Strait of Hormuz is closed until the end of March, I think oil is likely to rise to $120 a barrel. And if it's closed until the end of April, oil is likely to rise to $150 a barrel.
Okay, and this is still assuming this $120 and $150 per barrel by March end and April end, assuming that still half of the Middle East oil production continues to flow through alternate sources.
Yes, that's right.
Considering how dependent North Asian economies are on imported oil, if we do have scenario number one, $120 per barrel on crude, and scenario number two, $150 per barrel, what happens to the growth prospects, inflation? Have you worked out the numbers?
I think near term, it will be an inflationary impact. I don't think it'll have that big of an impact on growth for the rest of Asia. Even if you look at India, when we see spikes in oil prices in the past, we haven't seen GDP estimates to be meaningfully impacted. And so I think the impact around Asia over the next few months, if the Strait of Hormuz is closed, will be on the inflationary side. We have a bunch of central banks that are meeting this week. I think it's likely that central banks that were looking to ease policies are likely to be on hold, including India, Indonesia, Thailand, China, while they kind of wait things out.
Got that. Just a quick word, if I can. So the maximum amount of oil which goes through the strait is consumed by China. China alone is about a third. Number two is India. If these two countries can get their oil through the strait, why should oil prices go up?
Well, I don't think that just because China is the biggest importer of Middle East oil and they're able to get their oil through, that it has that significant impact on the price of Brent crude. And that's because many other Southeast Asian countries that have very low inventory levels are likely to continue to start ramping up their purchases of oils to restock their inventories. So I don't think that there's going to be that big of an impact if India and China are able to get their oil supplies through the Middle East.
Because that'll be about what? I don't know. China is about 35%, say India is about 15%, right? That's about 50% of the oil is to these two countries. I mean, yes, there are other large Asian countries which get their oil, but this is the bulk of it, right?
That's right.
Yeah.
That's right. But I think that we're going to see more demand buying as Asian countries that have low levels of inventory step up their buying for global oil inventories.
All right. Hi, David. Good to see you. When we last spoke, you were sounding relatively more optimistic on emerging markets, and India was the pick of the pack. Obviously, plenty has changed since then. But equity as an asset class could struggle this year. That said, if you had to put some money into equity, looking at the global markets, where would it be? And where does India feature now? With this big spike that we've seen on Brent crude prices, which obviously India is very, very sensitive to.
Well, let me just say that whenever there's a geopolitical shock, we should take a pause and take a step back and look at historical analysis. And so every time there's been a geopolitical shock, we've seen that markets perform well 12 months later. And so while there could be a bit of near-term headwinds as the volatility picks up due to market uncertainties, I would say that markets are likely to do well 12 months from now. And that's especially the case because India's economy is getting stronger. Prior to this geopolitical incident with Iran, India's economic growth was improving. The U.S. economy was also improving. Global growth was likely to improve this year relative to last year. So I'd say that markets are still likely to outperform over the next 12 months. And I think that for now, there could be a wrench that's thrown into the EM outperformance argument that I made earlier this year. But I think a lot of it depends on how quickly this geopolitical incident can be resolved.
Thank you. David, great to chat with you this morning. Look forward to more conversations. For now, let's tell our viewers what's lined up on the show today. So coming up at 8:35, the management of Jupiter Lifeline will discuss the impact of the LPG shortages. At 9 a.m., we'll be joined by Jyoti Gupta of Nirmal Bang to discuss and focus on the cement sector. 9:20, Anand Shah of ICICI Pru AMC will be our market master for the day. We'll talk all things markets. 9:35, we'll be chatting with Morgan Stanley's Jonathan Garner on the geopolitical risks and markets. Following that, the management of JK Cement will join in to discuss the impact of the war in West Asia, demand trends. And towards the end of the show, in our special Indianomics, Lata discusses why the IDBI divestment is flopping with former RBI DG SS Mundra, former Bain senior partner Harsh Vardhan and founder of Neostrat Advisors, Abhizir Divaji.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment. But we're looking at Reliance, Tata Motors, Leela Palaces. We have Sagar Cements, Oberoi Realty, Railtel Corp, Power Mech Projects, and RVNL. All of them will be reacting to positive news flow, while Reddington and Alkyla Amines will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time to talk stocks. Our entire research team is standing by with CNBC-TV18's list of top stocks for the day. The big one is going to be Reliance Industries. Sonal, they've inked a deal, a large $3 billion deal.
Oh, it is a large deal and very important strategic move for Reliance Industries as well. To give you the news first, it's a $3 billion deal for green ammonia offtake, which they've signed with Samsung C&T Crop. The commencement will begin from second half of calendar year 2029, and it is for a period of 15 years. Now, it provides long-term visibility for Reliance Industries' gigafactory or the green or hydrogen ammonia platform. So the impact, of course, is that it is an important move. It gives demand visibility for their upcoming gigafactory. And this is the first kind of an offtake that we'll see from an Indian company. Yes, of course, the financial impact will not come before FY30, but ICICI Securities says this validates Reliance Industries' integrated green hydrogen approach and also creates anchor demand for green hydrogen, also confidence of financing the project capex. It's a huge capex that the company announced 3 years back, and it is a significant milestone because now they are starting to see buyers for green ammonia, and that is very important for the company for the green energy vertical.
All right, that big boy does well. It'll be good for the markets as well, given its weightage on the Nifty. Thanks a lot for that, Sonal. Hopping across to Sudarshan. Sudarshan, tell us about Tata Motors.
Commercial vehicle demand has been strong for the last few months, and most of the analysts believe that commercial vehicle segment has been in the up cycle, and it's just the beginning of that 12 to 18 month cycle. But one concern that has been for the industry is the rising commodity prices. If you take a look at all commodities, whether it's aluminium, copper, steel, all these commodities have seen a rise in the prices by more than 10% in the last 2 to 3 months, and that's leading to a price increase by most companies. Same same day last year, Tata Motors commercial vehicle had increased prices by 2%. Now again, for FY27, that price increase would be effective 1st of April. Tata Motors commercial vehicle has increased prices by up to 1.5%, and company is saying it's to partially offset the impact of rising input costs and commodity prices. So that might help in reducing the margin impact because of increasing the commodity prices. That's the reason I'm going with green.
All right. So thanks very much for that. Well, more stocks with news flow. Vinny is here with that list. Vinny, good morning.
Good morning. First up, we have Leela Palace that's going to be in focus. We'll expect green here after they've entered into a binding agreement, and they'll be developing 71 luxury villas, ultra luxury villa resorts, and this is going to be in Kurg area. Purchase consideration 560 crores. What is the estimated revenue that one could see? The company has highlighted that they could expect revenue at a stabilized level of 165 to 175 crores with a margin profile of 50+% or similar to that Leela is seeing as of now as well. So positive here. Redington, we're expecting red here after its wholly owned subsidiary, which is in the Gulf region, said that the Gulf operations of the company are impacted because of the ongoing geopolitical tensions. Mainly, they've seen increase in transit time, increase in working capital, as well as delayed payments. Customers have requested that if they could make delayed payments, so they're receiving receivables have been delayed as well. Increased freight costs, insurance costs, logistics costs is something that is impacting them. Financial impact overall is not a number that they've given for it right now, but do not forget the revenue contribution that comes in from the rest of the world regions for the company. That's Middle East, Turkey, Africa is around 48%. This was as on 9-month FY26. Lastly, Sagar Cements and Andhra Cements, both these stocks is what we'll keep an eye out on after Sagar Cement is going to be offloading around 7.2% stake in Andhra Cements today and tomorrow. This is via OFS. This is mainly to meet the minimum public shareholding. So we'll watch out for both these names as well in the trading session. The floor price for this is fixed at 52 rupees. Andhra Cements yesterday was trading at around 51, so not much of a difference from the floor price as well.
Got it. Thanks a lot for that, Vinny. Hopping across to Ria. She's got some more stocks in the news. Hey, Ria. Morning.
Well, good morning. Let's start off with Oberoi Realty first. They have backed redevelopment projects in Andheri with a free sale area of roughly 17 lakh square feet. Alkali mines will also remain in focus today. They have suspended the production of key products which require ammonia due to a shortage of ammonia as suppliers have invoked force majeure. The financial impact of this is yet to be assessed by the company, but they've also highlighted that the production of other products that do not require ammonia will continue normally. Apart from this, three stocks will be in focus on the back of order wins. The first one is Power Mech Projects. They have bagged an order worth roughly 710 crore rupees. This is an O&M and overhauling order from Adani Group, and the execution will be completed by March 2031. RVNL has received an order worth roughly 95 crores. This is a 36-month contract from NMDC, and RailTel has also received an order worth roughly 43 crores from NICS, and the execution period for this will be 12 months.
All right. Thanks very much, Ria, for that. Well, just a quick recap of things as we've put them out this morning. So stocks with positive news flow are Reliance, Tata Motors, Leela Palace Hotels, Sagar Cements, Oberoi Realty, RailTel Corp, Power Mesh, and RVNL. Well, stocks with negative news flow are Redington and Alkyl Amines.
Well, let's turn away from the equity markets a little bit. Manisha Gupta joins us to tell us what's going on in the commodity markets. Morning, Manisha.
Morning, and thank you for that, Nigel. Well, overnight, we did see some decline coming in for the crude prices. Brent fell 3%. WTI was down 5% on reports of several tankers safely navigating Strait of Hormuz. Several countries also are pursuing back-channel talks with Iran to ensure safe passage for their ships. And then apart from that, the U.S. and Japan have said that they will release first tranche of emergency crude reserves in this week itself. It also has to do with the potential multinational naval coalition that could escort the commercial shipping via Strait of Hormuz. But as we start yet another day, there are concerns and some more attacks in various Gulf countries, and that has brought the crude prices back to around 3 to 4% of gains in the Asian markets right now. But apart from crude, there's very less that is trading in the positive because you have gold at a one-month lows. Silver continues to hold around that $80 an ounce mark. Copper has continued to decline for a third straight week. It also is pressure that we've seen come in for steel and iron ore, which were gaining in the previous week. Declines also have come in for the aluminum prices. That is off its 4-year highs as well. So apart from energy, not so much green.
Okay. All right. Thank you very much for that, Manisha. So that's commodities and focus. We'll take a break. We are back. We connect with the management of Jupiter Lifeline to discuss the impact of LPG shortage and more. We also have the our market team with us. Mayuresh Joshi is going to be talking to us about fundamentals and where markets are at in just a bit.
Welcome back. Yesterday, there was an article in the Hindu that hospital canteens in Kochi, I should correct, struggling amid the LPG crisis. It's mainly impacting the hospitals, the sterilization, pharma production, and many fear that hospitals may soon be forced to scale back or perhaps even suspend certain operations if the situation persists. Ankit Thakkar, CEO of Jupiter Lifeline Hospitals, is joining in, and we'll talk to him about the impact of the West Asia, if it's impacted supplies, the hospitals, the canteens there, the current occupancies and the RPOPs and the capex outlook. Ankit, thank you very much for joining in. Now, you're predominantly in West India. Have you faced shortages of any kind on account of LPG, which is impacting operations, maybe in your canteen, etc., or even in terms of medical supplies?
Good morning. Fortunately, so far, the hospitals in the regions that we operate have not been very adversely affected. However, we are beginning to see some signs of shortages. We do not face any disruptions as of now, as we speak.
So you said you're beginning to see some kind of shortages. Can you elaborate on what kind and at what point will it hurt?
So there have been some feelers about being conservative on the consumption, and looking at the current situation, we are just trying to be responsible around that. But as I said, as far as hospital operations are concerned and our kitchens are concerned for the patient use, fortunately, so far we have been largely insulated.
But you've got feelers about a potential LPG shortage, which could be directed even to the hospitals.
Yeah, I mean, depending on how bad the situation happens, hopefully we don't get there.
Okay, and where have you got these feelers from? I mean, has it come from the government?
Well, not directly to me. I've been hearing it from my team.
You've been here. Okay. Let's talk about the quarter then. How has the quarter been for you? Because I remember in the prior quarter, the volume growth was just about 2%. The growth was largely driven by your RPOPs, the average revenue per occupied bed. How has Q4 shaped in terms of the average revenue per occupied bed and a pickup in volumes? What's the number that we're looking at?
So typically, Q1 and Q3 are a couple of points lower in terms of occupancy as compared to Q2 and 4. Q2 being the highest because of the infection prevalence in Western India where we operate. So not too much of variation year on year. If you look at Q4, we should be pretty much in line with how we have done in the past.
Okay, got that. So what's the volume number we're looking at?
So I would not really be tracking volume numbers currently, but as I said, we are continuing to witness good growth in occupancy in Indore, where we have added new beds. So we should see a little bit of improved volume coming out of there. And similarly for Pune, where we added some beds, we should see some better utilization coming out of there. In the middle of this quarter, third week of February, we also started our new hospital in Dombivli, which is a little ahead of schedule. So in this last 6 weeks of this year, we'll also see some volumes coming out of Dombivli.
So occupancy in Q4 should be higher than what it was in Q3? Can it cross, say, 65%?
Yeah, it should be marginally higher than Q3. Okay.
What about capex? Because you all have the commissioned the Dombivli facility, the 500-bed facility that happened on the 15th of February. So that capex with 425 crore, I presume, was spent. But you have plans for Pune South, Bibewadi and the Mira Bhayandar, which comes up in the next couple of years. What's the total capex number and any more additions that you've outlined?
So you're right. We have these two projects underway. The Pune South construction has started. We are still underground in the basement. We are guiding for calendar year 28 launch. I don't see a reason why we should miss that. The capex for that, excluding land, we had said should be in the zip code of 500 crores. Similarly, the Mira Bhayandar hospital is in planning and regulatory stage now. As soon as we receive regulatory approvals for that project, we would begin construction there as well. So besides Dombivli, these are the two projects underway. We hope to maybe add another project soon. And once we have some clarity on that, I'll be happy to share that with you.
Okay, we'll come to you on the third project. What about medical tourism? Has that been impacted for you or for the industry?
So honestly, we have very little reliance on medical tourism. We are largely local service providers. So we have been insulated from that shock.
We'll talk again soon. Thank you very much for joining us, Ankit. And thank you for being here. Mayuresh Joshi is with us. He's Director of Research at Mark Smith India. Mayuresh, good to have you with us here. Good morning. Thanks for joining us. Yesterday we got a bit of a relief rally from the lows, a sharp one. How would you treat it? With trepidation. The first one is always treated with trepidation, whether this is a false one which will get sold into eventually, etc., etc. But it's also undeniable that many, even as perhaps you can make the case for more downside at an index level, many stocks are coming into buyable zones. I think 2-3 days back, somebody came on and said, well, stocks offering 20% earnings growth now available at 13, 14, 15 times. I was talking about something like a Mahindra and Mahindra yesterday, available at 20 times, trailing earnings now, Mayuresh. And that's a large cap, right? Near 4 lakh crore market cap company, but many others. Go on.
Morning, Prashant. No, you're absolutely right. I think two things. One, I think how long will this escalation in the Middle East linger is something that the street is really not sure about. And therefore, these intermittent bounces in the market based on certain news flows will keep on coming through. But unless there is some element of surety that the market gets in terms of news flow specifically related to this geopolitical issue, I think the markets might not make a structural move on the upside. Also, let's not forget, on the technical side, as my team was indicating, it was in an oversold territory. So I think some element of a bounce back was warranted. On the other part of your question, Prashant, you're absolutely right. I think there is some trepidation in the market still in terms of the second order effects if this lingers on longer, in terms of what probably happens in terms of input costs, what happens to demand, and therefore earnings that probably play out in the first half. But if it corrects further at the main index level, and the broader markets as well, I think stocks or sectors where earnings growth is expected to hold up comparative to certain sectors which are sensitive probably to input costs, specifically crude and crude derivatives, might continue doing well. Case in point, as an example, I think banks. I think the case being laid out is if there is some element of global inflation rearing its head back, imported inflation coming back, inflation in our own context heading higher, rate cuts are probably out of the window, but rate hike is probably a possibility. What happens to bond yields, etc., is something that is impacting these sector and the stocks as well. But in my opinion, I think if the headline index and the sector corrects further for some reason or the other, I think it becomes a good opportunity. I think banks like State Bank of India, the rating rankings, and if it consolidates and makes a good pace as we see it in markets in India at lower levels, becomes a plausible bet within the large private names, ICICI Bank, and even the mid-cap names, Karur Vysya Bank, as an example, have delivered solid set of numbers. Auto stocks, again, I think the entire trepidation is auto parts might be more costlier and the supply chain might be longer if this lingers. That is what is creating a lot of issues related to the sector as a whole. In our own opinion, I think two-wheelers possibly a tad bit better placed as we speak. Again, I think the entire universe will probably get affected. And a few auto ancillary stocks where I think the entire play in terms of both servicing the entire ecosystem right now and the entire EV agnostic platforms that are probably creating are steps in the right direction without creating too much of leverage. A few consumer-facing stocks probably might also do that. So some of these sectors, in our opinion, can do well, where earnings might hold up.
Hi, Mayuresh. Good morning. Good to see you in. It's getting hot here in Mumbai, and in the coming year, expectations are that power demand will come back. This year, for the country on the whole, the power demand is likely to be more or less flattish because the first 9 months were soft. But for this year, it could be 5 to 6%. I was speaking to Nikhil Nigania of Bernstein yesterday on Finding Alpha, And he made a couple of important points. He said the focus on power is going to be even more now, particularly post this geopolitical headwind that we have seen. And I was looking at a couple of names that he was bullish on. NTPC, case in point. We're talking about the markets pulling back. The stock actually is flattish in the last 1 month when the markets have corrected close to around 10%. What's your view on some of these names? How would you play the power theme? There's NTPC from the large cap names. You have Coal India. You have Power Grid. Various parts in terms of transmission generation. What do you like?
Morning, Nigel. I think that entire ecosystem might do well. The expectations in terms of peak power demand is expected to be significantly higher as we head into summer. Now, specifically coming to your point, I think NTPC probably looks like a very interesting case. Rating rankings look extremely strong at markets with India. They are adding 6.5 gigawatts in terms of thermal. They're expected to add around 20 gigawatts in terms of renewables as well. The receivable days from discoms has actually come down in the last quarter to 28 days from 34 odd days. The capex is well laid out at 56 odd thousand crores. And the regulated ROEs should be relatively stable going forward as well, with the capex to capitalization ratio expected to be pretty strong and stable. Again, I think in terms of the yield that it probably gives out at 2.26, and in terms of the price to book, I think reasonably placed. So I think this is one good solid story out of the large cap names. With the mid cap names, Nigel, NLC India is something that we're keeping on our watch list and radar. Our own sense is that the lion's share in terms of lignite production as far as power is concerned. And therefore, I think with the expectations and the plan and the vision that they probably got from a 2030 perspective, both in terms of adding thermal and renewable capacities, the margins are expected to trend significantly higher. 38% as they ended FY25, but expected to be 45 as they end FY27. And the exit run rate is expected to be 50% when they probably exit FY30 as well. They're getting into the red earth expectations as well in terms of the entire theme. And therefore, I think both from a valuation perspective and from an earnings perspective, I think these two stocks probably, within the large cap or mid cap, probably look solid.
Mayuresh, request you to stay on. We need to slip into a very short break. We'll come back and focus on some volume buzzers. We'll also connect with Sudarshan Sukhani and Mitesh Thakkar for some technical trading ideas. Stay tuned.
Welcome back and hope you're having a good morning. For the time being, the GIFT Nifty is suggesting at least we'll have a positive start, but a positive close is what will be eyed. Let's get in Hormuz. He joins in as always to tell us about all the big movers in trade yesterday. And some of them, Hormuz, saw a good amount of delivery. Take it away.
Good morning, Nigel. And yes, indeed, they saw a lot of delivery in yesterday's session. Indian Oil Corporation, one of them, the oil marketing company, is not doing well in this month itself. Today, another bearish call coming in for all of them. But Indian Oil Corporation was the big underperformer among the three. Fell almost 5% yesterday. And since the war began at the start of the month, it has gained only twice, has the stock. And even in yesterday's session, the volumes yesterday were the second highest volume seen in the last 5 months for Indian Oil. Close to 3.5 crore shares were traded. The 20-day average is less than 2 crore shares. 45% of those were marked for delivery. The delivery volumes in absolute numbers were the highest in a month, and close to 1.6 crore shares were marked for delivery. The 20-day average of around 93 lakh. And incidentally, just before the war began on the 27th of February, the stock had hit a 52-week high, and it's down almost 20% from those levels. The other one that outperformed the yesterday's session was MRPL. It was the biggest single-day gain since February of 24. Volumes were the highest on record for the stock. 14.5 crore shares were traded yesterday. The 20-day average of just over a crore. And only 5% of the number of shares traded were marked for delivery. Of course, that's because of the number of shares were very high. 80 lakh shares marked for delivery. The 20-day average is around 21 lakh shares, so 4x of the 20-day average. The turnover on Monday, close to 2,900 crore, almost 80% of its free float market cap, and it was the most traded non-Nifty 50 name on the Nifty 500 in yesterday's session. And the last one, the key trigger behind yesterday's recovery on the Nifty was HDFC Bank. The stock recovered almost 3% from the lows of the day, and it snapped a 3-day losing streak. And in the last 15 sessions, this is only the 4th instance in which the stock has gained. Volumes on Monday were the 3rd highest this year, and over 5 crore shares were traded. 20-day average of 3 crore shares. 55% of those marked for delivery, 3 crore shares for delivery, the 20-day average being around 2 crore shares. And the stock had recently fallen to a 52-week low of 812, recovering from those levels.
All right, Hormuz, thanks very much for that. Interesting numbers and interesting levels there. Mayuresh is still with us. Mayuresh, Hormuz mentioned MRPL, but there was also Chennai Petro, which went up sharply, right? I mean, there is a refinery shortage, etc., which is coming through as well. But I saw some headlines yesterday that the government may actually cap. The government will not allow refiners to profit from this unusual situation. That is, I think, it came through in the afternoon. Didn't get too much attention. I was surprised by the very sharp moves. Any thoughts, Mayuresh, on this one?
No, so I think it's moved significantly. And I mean, the GRMs have moved significantly, what I meant to say. And therefore, I think the delta spreads in terms of the refining margins, and therefore the expectations in terms of how the numbers will play out will be significantly higher as we head into Q4. Again, Q3 numbers were phenomenal for all these companies. Again, as the news flash you're saying, Prashant, if that properly plays out, that does cap the earnings expectations for these companies in general.
Mayuresh, if I can come in there, sorry. I'm being told in real time by our colleague Sudarshan that the government came out with a clarification last night. It denied it. It was a news report, and the government denied it last night that they have no plans to curb. And that's just Sudarshan is just telling us that right now. So yeah, there's no fear of that. So given that the government has denied any such move, would you look at these companies? I mean, the standalone refiners, but even names like Reliance.
I think it will have a good number again. Again, Q4 numbers will be phenomenally better, Prashant, in that sense. And therefore, I think from a swing perspective or from a tactical perspective, it does make sense that Q4 numbers will be significantly higher. For Reliance as well, Prashant, I think the kind of feedstock that Reliance probably has, we've always seen that Reliance always produces GRMs which are $2 or $3 more than Singapore GRMs. And therefore, at this juncture, it tends us to believe that the numbers on the refining front will be better. The retail businesses are holding up on its own, specifically in terms of both Jio as well as Reliance Retail in terms of the EBIT contribution. And therefore, as we head into Q4, I think Reliance numbers should also hold up. So anybody holding Reliance should hold on. MRPL Chennai can absolutely be taken as swing or tactical plays from a Q4 perspective.
All right. Fair enough. Mayuresh, thank you for joining in. Good speaking with you. Always a pleasure. We'll take a quick commercial break here. There's news for Kalpataru projects. They've backed an order for an underground metro rail project worth about 2,500 crores. So that is an order coming through for Kalpataru projects. 5 minutes away from the pre-open session, Jyoti Gupta of Nirmal Bang will focus on the cement sector when we come back. That's in just a bit. Okay, 2 minutes away from the pre-open session. Sudarshan Sukhani is with us. He's joined by Mitesh Thakkar, who's with us as well, with trading strategies and stocks that they'd like you to pick up or sell. Gentlemen, morning. Great to have both of you here. Sudarshan, you go first. We got a rip higher yesterday. Today is weekly expiry. What's the setup looking like, and what are the trades to take?
Yeah, good morning. Well, yesterday I suggested if the market stabilizes after the first hour, 2 hours, we should buy above 23,150. Now that trade continues. If you are long, I think you should be long in this market or sell and then buy. The trade today is buy on a dip towards 23,350. So wait for a 100-point correction intraday, which could easily happen, and then go long. The first signs, it's not just India, all world markets are giving the first signs that maybe at least temporarily a low is coming in place. So we really want to be on the long side of the market, keep a wide stop, give some room for breathing, buy around 23,350 and then hope for the best.
Mitesh, what would the approach be? Are you getting a sense that there is fresh conviction buying or just some selling exhaustion that crept in yesterday's trade?
Yeah. Good morning. So, I've been saying that it's a combination of two things. Basically, one, we are extremely oversold on the short-term charts. Two, we were at very important pivot supports on both the Bank Nifty and the Nifty and many of the heavyweight stocks. So I think a pullback is what I was looking at. It can be a slightly stronger pullback. We'll figure that out in the next few days. But for the timing, I think, as Sudarshan also highlighted, chances of a temporary low being made are quite high, given the fact that we are at historical oversold levels on indicator basis. And therefore, I think next few days could be spent with volatility, but with mild upward bias that basically the pullback will play out and it will be slightly volatile. So in the short term, I think, people, and this is what I said yesterday also before the market opened, that people who have short positions on the indices, good time to take at least 60-65% off the table, book profits and see how the pullback pans out.
Okay, let's talk stocks then. Perhaps markets have made just an immediate near-term bottom. So Mitesh, is the approach buy stocks now? Are you going more long?
For the timing, I have mix of buys and sells. A couple of days back, it was only on the sell side. Today, I have 2 buys and 2 sells. On the buying side is CG Power. It's done well in this falling market and now given a pullback to its 20-day, 30-day averages. So buy here with the stop at 687 for a target of 720. Could go trying to find a base around this 170 odd zone. So buy with a stop at 168.5. Look for targets of 179. On the selling side is Oberoi Realty. It broke a very critical support of 1450. So if you get it around 1425, 1430 in the early morning trades, 1452 being a stop loss, shorts can be taken for targets of around 1370. And sell on Jindal Steel around 1145, 1150 zones can be sold with a stop at 1170 for targets of around 11.
All right. Those are some trading ideas. Sudarshan, what would you go with?
Well, I have mainly a long list. Buying is more. ICICI Bank is a buy with a stop under 1248. Tata Steel is a buying opportunity, so I have 2 large caps with a stop under 183. Worry Engineering is a buy, and Worry Energy is a buy with a stop under 2735. My only short is Godrej Properties with a stop over 1585.
Okay, all right. Sudarshan and Mitesh, thanks very much, both of you, for that. The pre-open, by the way, is kicked off. The rupee is opened slightly stronger. Nifty is up 100. The sensex is up about 400, 450 odd points at this stage. Jyoti Gupta, Senior Research Analyst at Nirmal Bang Institutional Equities. Jyoti, good morning. Great to have you with us here. Thanks for joining in. Nigel will come in on cement in just a bit. I just wanted a quick word on defense, if I can ask you, Jyoti. You have coverage, right? Defense?
Yes, I do.
Yeah. I mean, it's the one defense, offense. That's the whole gamut of things right now, right, in the world. Anywhere you look, that's basically all these conflicts, etc., driving at all-time high the level of conflicts. So just your thoughts on the space, and thematically, I'm assuming that it's pretty easy to push defense stocks to clients. Maybe valuations are a pushback, but just your thoughts, Jyoti.
So defense, of course, even for the next 5 years looks very lucrative to me, but of course the valuations are rich. But I think the sector kicked in mainly because of high order book, but now the execution is what is going to, the industry will observe massive execution over the next 3-4 years. I think that's very positive. So overall, and the order flows is not a worry at all in this sector at all. So the space definitely looks very, very good.
Which is the topic? From companies that you've spoken with and you're in touch with, any feedback of any disruptions in production because of all these gas issues, etc.?
No, not till now. What I have understood is possibly we'll see major, deliveries in the month of March. So, typically where we saw was certifications, nothing to do with gas disruptions and all. So the sector is quite good, well placed.
And who is best placed on the defense pack?
My top picks are HAL, BEML. Data Patterns, which has already run up quite a bit, but still looks very good, and Solar Industries. Otherwise, I think BL is a long-term compounder.
Okay, all right. So let's keep defense at the side then, and let's focus on the cement sector. Jyoti, what's the feedback you've received on ground? Is there any dependence on gas, first of all? Have you, in your interactions with the companies, have you heard of any kind of production scale back? A broad feedback that you've got since the outbreak of this war?
Good morning, Nigel, and thank you for having me on the show. So basically, the sector is far more exposed to petcoke and coal prices, which accounts for almost 85 to 90%. So the gas shocks basically impact the fertilizer and tiles industry. So this industry will have minimal impact because it's hardly, less than 1 to 2% of the entire fuel is gas. So roughly no.
Okay, so let's talk about that then. Petcoke prices as well as coal prices, they have scaled up. I think the negative impact, though, will be seen only in the second half of the first quarter or maybe in the second quarter, because for the time being, there'll be some inventory that they're sitting on. Could you tell us what is the feedback in terms of the raw material basket? How much is it up? And who gets hit the hardest? You know, if you're looking geographically, some of the players will be importing a higher percentage or using a higher percentage of a particular product. So who could get negatively impacted?
Petcoke has increased by 17%, so has your imported coal. There has been some relief on the domestic coal prices, but that would not offset the increase in prices. I think the hardest hit, if you look at the mines, placement of mines, it is actually east. So eastern regions will be well off in terms of the coal prices, but hardest hit would be the plants in the north side and the south, and to some extent the west. Depending if you're grinding units, it's not a trouble. It's basically the integrated units which are in the north, south, and some in the west would be more hard hit. But in fact, the impact of if I look at the overall industry, how it looks to how I see it, that first half demand we were close to around 8.5%. Say for 9 months we did almost like 9.5%. But this time volume, first 2 months Jan and for Feb we were close to almost like double digit. High single digit to double digit, but March is going to be slightly lukewarm, mainly because of the two things. One is your non-trade would be impacted because the shift in government spending could be temporary from infrastructure towards from infrastructure towards subsidy amid fiscal pressures arising from Iran-Israel conflict. This may have a spillover in your first quarter as well of FY27. So we expected full year demand to be high of double digit, but I think we closed the year to somewhere around 8 to 9%. In terms of cost, in fact, realizations also, while we've seen increase in prices in the non-trade and trade prices, and they have stayed as well, but because of the lack of demand in the non-trade side, I think the increase in trade prices, despite the unavailability of bags, will offset the improvement in realizations per ton as well for the overall industry. So we had expected around 5 to 6% improvement in prices on a year-year basis, but now we're going to taper it to some tone down to maybe 2 to 3% in the realization per ton.
Okay.
Overall fuel costs, we believe, will have an impact of 6 to 7%, while the fixed cost absorption may be high, but that will not be able to offset it. So, and we earlier estimated almost like a 20-25% improvement in beta per ton on a YOY basis by FY26, but I think we'll see somewhere around maybe 12 to 15% improvement.
Okay, all right. Jyoti, actually the cement space that we track very closely would have been bracing for a very, very good quarter. Unfortunately, this war broke out and, things have got a little bit muddled actually in March itself. Otherwise, Jan and February were good. Price increases, demand was strong as well. And unfortunately, this has really spoiled the mood. And if you wanted to play something that was not related to the trade agreement, then it was cement. But that said, I think you are quite bullish on a couple of stocks. So what is your top 2 picks, if you could help us out with the target prices?
See, in the current scenario, if I see, I would rather have my core allocation on large caps, be more tactical on the mid caps, and avoid any weak regional players with high debt. So in that scenario, I would actually look at, be more positive on Ambuja, then Ultratech, JK Cement, and, Shree, but the valuations are quite rich for them. So yeah, my top picks would still be Ambuja, I'm looking at something like 702 rupee. RTP is almost around 700, and for Ultratech, we're looking at something like a 12,526 is our TP for 256 is our TP for Ultratech. Ramco does look good, but again, the petcoke prices, we're not sure how much would be the impact, but I'm still very positive on Ramco Siemens. And Novoco, because of the best, geographical placement in the east, and then again, north plants could be impacted by petcoke. But overall, I think these four companies do look quite good to me at this point of time.
Jyoti, always a pleasure speaking to you. And what I appreciate is always you have your ear to the ground. You're very, very close to the ground reality. So it's a pleasure to have you on the show. Thanks for giving us a bit of a preview into the defense companies as well as cement. We'll touch base soon.
Thank you so much.
All right, let's welcome Sudarshan Sukhani back on the show for the 9:10 call. Sudarshan, tell us, what's it?
It's Tata Steel. Buy Tata Steel with a stop under 183.
Interesting one. Domestic prices at a bit of a discount in comparison to imported steel as well. So let's see how that one goes. It's pulled back from the top, but Sudarshan is positive on that one. Mitesh, what about you?
I'll go with a sell on overall reality around 1425, 1430 zones.
Right, thank you very much for that. Let's talk about oil marketing companies, because today Kotak Institutional Equities has sharply cut the target price on all three, IOC, BPCL and HPCL. So now take it away.
This is the second target price cut that is coming. Yesterday we saw one, and today Kotak Institutional Equities have increased their assumption on oil prices to $85 per barrel for FY27, 75 for FY28. They say the Hormuz disruption has skewed this on the upside. With limited retail pricing freedom, the oil marketing companies, they will not be able to hike prices, and that is something that will continue to hit their marketing margins. LPG shortages, that has also created a negative sentiment. However, for household, remember, it continues to be at the levels which are required. OMCs benefited from the elevated marketing margins in the recent years, but that is expected to continue, and that's the reason there's a target price cut. However, they expect LPG capex to continue and production to increase from here on. They say that IOC's target price is cut to 100, for BPCL it's cut to 240, and HPCL it's cut to 235. That is where the sharpest cut has come, because remember, HPCL has the highest exposure to the marketing segment. Now, if you look at some of the delivery stats for BPCL, the total traded turnover yesterday was around 570 crore rupees, but only 55% was marked for delivery. The stock is down around 19% in last 1 month. For HPCL, the total traded turnover was around 518 crore rupees. Again, only 53% marked for delivery. The stock is down 22% in last 1 month. For IOCL, the turnover was 533 crore rupees, but 45% only marked for delivery, and the stock is down around 16% in last 1 month. So a lot of positions taken on the downside for these stocks, so keep an eye out on them.
Thank you very much for that. Let's talk about EMS companies. Syrma, Amber, they've all fallen 20% plus from the recent 52-week highs. Upasana joins in with what JP Morgan advises investors to do.
Well, JP Morgan has put the focus light on EMS sector, and it has gone ahead and upgraded 3 stocks in the sector. Cyan DLM, it has upgraded to overweight from neutral with a target price of 400. Amber Enterprises again upgraded to overweight from neutral with a target price of 9,000. And it has identified Syrma SGS as the top pick within the sector with the overweight rating and the target price of 1,050. Now, the brokerage says that the EMS stock underperformance has led to investors question whether the sector story is over or not. But overall, the brokerage rejects this thesis and believes that it sees every stock, barring Dixon, delivering more than 20% of the revenue growth over FY26 to FY28. Further, it also sees the sector upping its value addition, evolving from finished products assembly to component and PCB manufacturing. In terms of valuation, it believes that the valuations have eased out after the underperformance, but it remains at risk at levels of 32 to 60 times FY27 estimates for the stocks that have missed expectations. And overall, it has also placed emphasis on 2 stocks, that is Syrma and Amber, as it believes that it is most likely to beat the street expectations going forward. So all in all, this is what the JP Morgan thesis is on EMS sector.
Okay, all right. Well, let's just quickly recap the list of stocks that we've covered since the morning today. and they'll come up on your screen. Reliance is up about 0.25%. Tata Motors is up about 1.6%. Leela Palace Hotels is absolutely flat. Sagar Cements, Oberoi Realty, Railtel Corp, etc. are up on your screen, 1% each. Power Mech is up 5%. RVNL is up about 1.25%. Reddington, Alkyl Amines are some of the other names which are flattish to slightly lower, sideways, etc. So 84 points, 23,500 is where the Nifty is at. 75,826 is where the sensex is at this point in time. The first rates will start to come up. We'll look at them and then we will move forward. What do we have? 23,493 on the Nifty. So, 60 points on the Nifty. And you got the Nifty Bank, which is up about 0.25%, 54,550. So it's a higher start. It's a decent start. Let's see if this can become bigger or stays here through the course of the day. Okay, coming off a little bit at 0.14, 0.15%, 23,430, 23,440 or so is where we're at. The market breadth is positive, over 2:1 in favor of advances to declines. And that's the heat map. It's a more normal kind of a day with lots of stuff up, lots of stuff down, at least on the Nifty. Tata Steel, BEL, Max Health, etc. are starting in the green. Infosys, HCL Tech, Wipro are starting in the red at this point in time. Markets now flatlining, just about 7 points left on the index. Rima.
Well, indeed, markets are attempting a comeback, but there is still caution in the air. Remember, Brent crude prices have crossed $103 per barrel in today's trading session, which compares with a little more than $100 per barrel that it was in yesterday's trade. The Nifty and the Sensex, after opening up higher, have now dipped into the red. Sensex down 35 points, Nifty lower by 15 points. Yesterday, we gained 250 points on the Nifty. This morning, unable to build on that upward momentum, at least in early trade. So let's start with the loser, since the index is flashing red. It's I think the biggest loser today are the IT names: Infosys, HCL Tech, Wipro. They're down nearly 1%. Asia's in the green, but the big gainers there are the ones related to AI, the NVIDIA beneficiaries like SK Hynix, TSMC. So India doesn't really have that play, and you can see the softness in IT names. Top 3 Nifty losers are the IT stocks. Then you've got Adani Ports under pressure, Eicher Motors on the back foot, HUL, Titan, consumption names are weak. L&T is under pressure. That's down close to about 0.5%. On the way up, metals are doing well. You've got Tata Steel with a gain of about 0.75 percentage point. BEL, defense continues to see buying. Asian Paints in focus. Many of the paint companies had announced price hikes following the rise in crude prices. So that's supporting the strength in Asian Paints. ICICI Bank, in fact, banks too are in the red. Yesterday, banks made a comeback. There was buying visible in many of these large cap banks. But today, there is green when it comes only to an ICICI Bank. HDFC Bank currently is in the red, and that's dragging its feet with a cut of nearly 0.5%. Reliance Industries should come up for you on your screen because they made that big announcement, a $3 billion deal with Samsung C&T for a 15-year supply of green ammonia. Reliance Industries is on the flatter side. All in all, the Nifty is just a shade below 23,400, unable to add to yesterday's gains.
Well, this 23,500 has become an important resistance mark. Even today's gap up, the high of the day is around 23,493. Yesterday's high was around 23,500 or thereabouts. So a higher high is something that you're hoping for. But that's not happened in today's trading session. So that's something that we'll track. Even on the Nifty Bank, yesterday's high was at around 54,664. So you'll want that number to get breached. Individual stocks, that we're looking at. Kalpataru, that stock, in fact, is up close to around 8%. There was an auto bin out there, so that one is bucking the trend. Bajaj Electrical, fundamental positive news coming in there. That stock is well up close to around 5% as we speak. So good move is what we're seeing on that name. ITI, yesterday the stock moved on high volumes. Today as well, it's seeing some follow through. So good move on that particular name. Big move is what we're seeing out there, and some bit of a follow up. Jindal Saw as well up close to 100%. On the flip side, MRPL that spiked up yesterday big time. That's coming for profit taking. In the final hour, you saw Ola Electric that spiked up. That as well has come in for profit taking. And Reddington, just a month or so ago, the stock was close to 300 rupees. That's corrected to around 220 rupees. So a flattish start. The good news is number of stocks advancing, at least equaling the number of stocks declining just for now.
All right. I think we've got, things flattish now. By the way, silver Bs once again, right? I mean, I can see spot a lot of these silver ETFs which are up 3%, 4%. International silver prices are back above $80. So that is something. I mean, silver has been a huge area of trading activity all through this year, all through this, this 2026. Well, I think just a few other names. GMDC is up 3%. It's the number 3 largest volume-led gainer. Amber is up about 2%. Bajal Products, I think it was coming up 2.5% on this one, 172. It's coming up with very large volumes. So yeah, I mean, there is some stuff. GE Shipping is coming up with about a 3% pop, but you know, volumes are low. I mean, the volumes are there for about 10 stocks. I'm talking about NSE 500, and then volumes taper off completely, at least right now. Coforge is coming up with a 3.5% cut, 1,045 on Coforge. It's got volumes on it, on the downside. So keep an eye on that. Hindustan Copper is down about 2%. So NTPC Green is down about 2%. Again, I mean, you know, 10 stocks have got volumes on the downside, and then things taper off completely. So 23,378 or so on the Nifty. Anand Shah is with us, CIO of PMS and AI at ICICI Prudential AMC. Anand, good to have you with us here. Thanks for joining us. So, you know, for viewers who are watching, Anand, what's their advice really? Those who've been able to create some cash at higher levels, is this time to go back in, deploy in what way, shape or form? Like an ETF or, you know, large caps, a small cap fund? I mean, what would you recommend really?
Hey, hi, good morning, Prashant, and thanks for having me. So, yeah, I mean, we all along maintain that asset allocation is way to go, and one needs to be keeping an eye on asset allocation. As far as the situation that we are in today, I believe we don't have yet the end game here, and to that extent, it would be too premature to say that we have seen a bottom of a market, and to that extent, one should deploy all the cash that you have or all the cash that you might have raised to redeploy in the market. But I think we have some comfort that markets have become more reasonably priced through the last year. So it's not only this last 2 months, but otherwise also India has been one of a large underperformer through the calendar year last year. And to that extent, the relative valuations of India relative to the emerging markets in the world have become reasonable. And to that extent, I see it's a time to keep on adding a little bit on the equity at this point of time.
In what way will you do it? I mean, what's the instrument to do it? No,
I think, look, it's much more complicated than where we were a few years back, especially at least 18 months back. Very clearly, some things remain constant, which is India's demographics and the very stable macro.
Anand, what I mean is, should you go and buy I mean, in a systematic way? No one knows. No one rings the bell at the bottom or the top. With that realization in mind, how would you sort of slowly start to go back in? And because you can't perfectly time the bottom, it may be 1,000 points lower from here, it may be 500 points, who knows, right? But you got to start to do sensible things. But what's the way to do it? Is it through exposure to through an ETF? Is it through a diversified equity fund? I mean, a single stock? That's my question.
I think now the products are time tested. ETFs give you passive exposure, mutual funds give you active exposure. You get an advantage of having a fund manager doing stock picking to you in mutual funds. So either routes, you know, or a combination of a passive and active. But what I was trying to say that the markets have become far more complicated to go directly into equity. And that's why I'm saying a professional use or a passive fund is a far better choice for an investor at this point of time than doing an actual bottom fishing on individual stocks.
But equity diversified or a small cap? I mean, an experienced small cap. You'd go with an experienced small cap fund manager. Given the damage we've seen, that's my next level question, Anand.
Indeed, I think the small caps again, like Indian equity markets, have underperformed significantly, and valuations is not that big a challenge as it was maybe in September 2024. But that again, one has to understand what is changing. While some things are constant, a lot of things have changed, and one of them is inflation. The outlook on inflation and this current energy crisis only complicates it. But even before we reach this current energy crisis, we had tariffs. I think, and in a way, we are moving more toward the globalized world to deglobalize, more local manufacturing. So it has implications on inflation as it is. Interest rates were expected to inch up. Now there's additional burden of a higher energy prices across the value chain of gas, oil, coal, and everything. That complicates the matter further. It's only we need to see how long this stays and whether it has a permanent impact on the inflation outlook, because that has then implications on the stocks. Which stocks would do well, which stocks would underperform, and which would have been very different 18 months back.
So the mid-teens earnings growth expectation, Anand, for this year, is that at risk? And has your team told you which sectors, themes, where we could see cuts in earnings on account of the conflict, higher inflation? They may not be able to pass on the entire burden.
Indeed. So look, while India or at a NSE 500 level, we might have still a double-digit earnings growth rate, but the contributors to those earnings would actually shift. What are the higher commodity prices, higher inflation means that the asset-heavy businesses, the commodity producers versus commodity consumers. So commodity consumers can suffer, but the commodity producers, be it oil producing, coal producing, even metals manufacturer, those are the businesses which will actually might have a certain more than expected jump on the earnings, while to counter that, there would be the commodity consumers like autos and others might have some bit of lower profits or maybe a degrowth in profits because of this combination. So I think from the investments perspective, I think few things have changed. I think from our perspective, preference for value over growth, preference for profits today versus profits 5 years out, preference for more asset-heavy business or asset-light business is something which we have been continuously monitoring. And while we are doing stock picking and individual stocks matter more than sectors, but we are cognizant that a higher inflation means a segment of the market will outperform the other segment of the market, which would have been completely opposite 18 months back.
IT down now 25% from the start of the year, Anand. Do you think the potential derating is done or there is more to go? I'm not talking about numbers. Now, usually valuations get adjusted well before we see it in the actual numbers. But just purely in terms of the valuation right now, do you think there could be more pain?
Sorry, I missed the initial part. Is it the
IT, the Nifty.
So yeah, again, immediate threat to the EPS is small compared to what the stock price has fallen. What actually people are still trying to figure out, and that includes us, that what would be its implications on the terminal growth rate, and that means what would be implications for a PE multiples for this sector. Do we see that the AI sustainably disrupts the total pricing power and it leads to a significant deflation to the pricing of the IT services? Then obviously things have changed. So again, we remain cautious on the sector and we continue to monitor it very closely. Again, I am repeating, they're high quality businesses, the cash generation is very strong, and the near-term risk to the earnings is much lower than what the stock price reflects.
Hi, Anand. Good to see you. And Anand, there is some kind of nervousness that's coming about from the mature retail audience because they haven't seen a big correction in the last few years. It's been pretty okay. Buy the dip and you make some money. So in terms of top-ups, in terms of putting incremental money to equities, someone had say 100 rupees or thereabouts. How much should they start dipping in post this recent correction? And given the fact that we're a couple of weeks into the war already.
No, again, look, if you have first and foremost, very important that
a long-term investor
in any environment as it is, you should have a long-term horizon, and more so importantly, while our outlook on the Indian economy and the markets might we again normalized, say, end of June and July, we might not be discussing these risks because Strait of Hormuz would have somewhere settled and the flow of energy would have moved, maybe at a higher elevated price, but it will be still normalized. And to that extent, we'll go back to stock picking. So what we are telling our investors and our advisors that, look, it's a time if you have a room to increase allocation to equity, you should do it over a 2-3 month period, because at some point of time, either the energy prices go up significantly and that leads to a demand destruction in energy, or alternative energy supplies took over, or basically there is some bit of thaw and there is a 20% of crude that moves through Strait of Hormuz starts moving, maybe albeit at a lower capacity, but it starts moving and things go back to normal.
Anand, that long-term thing, right, is that you should buy for the long term, and you should, I guess, but you would completely, I'm assuming you would agree that the pace of disruption also feels like it's at an all-time high, right? At least perceptions of disruption or actual disruption, we don't know, but it looks like everything is getting, we don't know the terminal. It's tough to kind of put a terminal value to anything at this point.
Very interesting that you raised this point.
Yeah, let me, and I'll ask you to come in. But my point was, and tie this to the fact that what you said in the beginning, right? Because it's so volatile, better to give money to a professional fund manager, right? And they'll have to sort of go in, go out, and long term, short term. And so it's, but then it's also an environment where the skill level of the fund manager also matters a lot more, right? Compared to 10 years back. Not that it didn't matter, it always mattered. But I'm just saying that if the first part is true, the second part is also true in that sense, right? So makes a lot of difference who you give and where you invest now.
No, indeed, I think good you raised this point. But again, as much we all sort of discussing AI and its implications on various industries, it's good to remind ourselves that, it's not the first time that there is some innovation, some new technologies coming through and which is disrupting certain businesses. It happened in the Industrial Revolution, it happened in the Digital Revolution. What it leads to, it obviously leads to a certain industries taking a much larger knock because they get disrupted. And invariably, these are the businesses which are high ROE, high profit-making businesses, which in turn gets disrupted. But it also leads to an evolution or an emergence of new businesses. Just case in point, as the 4G sort of got fairly penetrated in this country, we had emergence of quick commerce businesses and so many new age businesses which are now recently getting listed. They would not have been possible. They would not have been there in the absence of that 4G technology. So every technology evolution will also lead to emergence of new businesses. At the same time, certain old age businesses which might get disrupted and might actually become a low growth or a no growth businesses as we go forward.
Yeah, no, that's absolutely true. But and eventually maybe it'll lead to abundance and everyone will be better off. But you got to get from point A to point B, right? And that's the problem. And that is 5 years, 10 years, who knows? And you got to be okay, all right, to come out all right on the other side. And
absolutely.
Yeah.
Absolutely. And as Nigel said, we haven't seen very sharp and long corrections in almost last 15 odd years. And to that extent, one should not forget, but we can actually have a low growth or a low earnings growth rate. Luckily for India, we have seen that between almost 2010 and 2020, we had abysmally low earnings growth rate while the economy was still doing okay. And we sort of survived that. The profitability was shade below 2% for almost 5 years between 2015 and 2020. So yeah, I mean, there's no doubt in my mind that a certain change in the environment can lead to a very low earnings growth rate. And that's why we, beginning of the year, stated that from here on it will be more stock picking. We'll need to stress test every company to the emerging macro risks and even macro opportunities for that matter, and see which of your companies are adapting to the changes, be it the new challenge being the higher energy prices to the AI challenges that we have.
Okay, all right, Anand, we'll leave it there. And Thank you very much for joining us. It's a pleasure having you here on CNBC TV18. Well, I think what we're going to do is just look at the market, which is down 8 points. 23,400 is where we're at. Which means, let me just take a look at what we've done so far, right? I mean, I think, so we started, the market went to about almost 300. Then there was a very sharp sell-off and we got to about 22,980. A very sharp, sorry, beg your pardon, I'm looking at yesterday's session. Okay, we basically got to start higher, right? 23,500 was the high today, almost 23,500. And we've given that up, but we're off the lows as well. The low for the day has been made at about 23,360. So about 30 points off the day's low. So yeah, I mean, contained for now. Yesterday, of course, was much bigger, much wilder swings in that sense. Well, Tata Power is in focus. Vivek is here to tell us why. Vivek, take it away.
Well, that's right. You know, this is a verdict that could have an impact, especially as far as consumers are concerned. You may now be able to choose, who will be your power supplier. Now, what's actually transpired is that there has been a verdict that has been declared at APTEL, which is the Appellate Tribunal for Electricity. That APTEL has gone ahead and dismissed BEST, which is Brihan Mumbai Electric Supply and Transport Undertakings appeal against a past Maharashtra Electricity Regulatory Commission verdict as far as parallel licensing is concerned. APTEL has gone ahead and ruled in favor of Tata Power for Tata Power to go ahead and do a phased parallel rollout as far as distribution network in the state of Maharashtra is concerned. Now, what is the background for this particular case? Remember, multiple companies had applied for parallel licenses for various areas across Maharashtra in FY23 as well as FY25. And post a 2-year period, the commission, which is MERC, had gone ahead and accepted as well as admitted applicants in June 25 that qualified for a grant of parallel licenses. Now, BST had gone ahead and appeal against the MERC decision, saying that they had undertaken significant capex and they do not want competition in areas where there was existing infrastructure on which they had done the capex. Now, JM Financial today has written on this particular development. They say that this particular move has implications on electricity amendment bill's proposal for carrier as well as content separation. They're saying that the likely passage of the bill during Parliament's monsoon session opens up huge opportunities as far as the distribution space in India is concerned. And they say that the likely beneficiaries include Tata Power, Adani Energy Solutions, CESC, as well as Torrent Power.
Thank you very much for that. Jonathan Garner, Chief Asia Emerging Equity Strategist at Morgan Stanley, is now joining in. Thank you very much for joining in. This is Rima here. Now, you downgraded India to an equal weight very recently. This happened in the early part of March. The question is, why now? India has already gone through 1.5 years of a time correction, price correction, and a very steep underperformance versus the rest of the emerging markets, Asian peers. So why now? Question number one. And two, with now an equal weight, what should we expect from India, say, in the next 12 to 18 months? No returns or very muted returns?
Yeah, so we made a number of changes to our recommendations about 10 days ago, and it's really all to do with the framework that we're in right now in relation to oil and gas supply. It is unfortunate for India because in January, the manufacturing and services PMIs moved up. And we obviously have had significant policy easing in India, and we had been cautiously optimistic about the business cycle turning and running a small overweight. But unfortunately, India is one of the countries in our coverage that has the most sensitivity to oil and gas imports within GDP. It's actually the third highest after Thailand and Korea. And so the prospects for the economy are dimming in this environment. It's also the case that India has relatively low reserves, strategic reserves of key commodities. They're significantly higher in the case of Japan and China. In terms of the second part of your question, we're emphasizing very wide bear to bull outcomes here. And in fact, this predates what's going on in the Gulf. We'd felt that geopolitical risk was high going into this year, and AI disruption was also high as a theme. And so I wouldn't want to put any firm estimates on likely returns for markets at this point. It's really a case of scenario analysis and very wide ranges on potential outcomes.
Jonathan, morning. Prashant here. So would you want to give us those, those Ranges on both sides? Both sides? I mean, you said they're very wide.
But broadly for Asia Pacific, we are in the world where if we do sustain interruptions to product flowing through the Straits, and you can proxy that through the Brent oil price going to $120 to $130, but obviously some regional benchmarks are well above that, and there's quantity issues as well as price issues. In that world, we would see around 15 to 20% further downside. Broadly, Asia has declined around Asian equities around 8% so far. To return back to base cases, were the oil price to fall back to $60 to $70 a barrel and product flows to resume quite quickly, you would maybe have something like 10% upside. So it's actually somewhat adverse from a risk-adjusted perspective.
Okay.
And I think some investors sort of view this as similar to last April when there was a very rapid V-shaped recovery in markets, but that was caused by a significant and rapid de-escalation in trade tensions between the US and China in particular. And that's not what we appear to be looking at currently.
Jonathan, just to, so you're saying that MSCI Asia Pacific ex-Japan, that's the index we're talking about, has got another 15% downside if the disruption persists?
Broad MSCI Asia, including Japan, is down around 8%, and we would have 15 to 20% downside in the adverse scenario where you'd be heading to a recessionary outcome across Asia. In the adverse scenario, that's not yet the case. We're trading obviously around $100 on Brent, which is our intermediate scenario currently.
Okay, and this is and what would it take for a recessionary kind of environment? Over 100 for an extended period of time?
No, $120 to $130 and the associated interruption of product flows. It's quantities that matter, not just on oil, but on gas. And then the downstream effect of that on industrial production throughout Asia, production of things like fertilizers, for example, which are very important for India. It's that adverse scenario that would cause a more significant adjustment in equities.
One is, of course, we're going to ask you market outcomes and what you think of markets and what looks good or bad. But you know, what is Morgan Stanley's sort of team, say, in Washington telling you with regards to the war itself? What's the base case? How long will this go on? And what are the likely, what's the likely shape of this over the coming weeks and months?
I can't comment on that question. I'm not a military analyst or strategist. I'm an equity strategist.
Okay, fair enough. So there's no base case in that sense. I mean, I spoke with somebody at Fitch who said yesterday on the sovereign side, they said maybe a month is what they think this kind of goes on for. So I thought maybe internally there is a base case on this one.
Our framing of this is in relation for Asian equities and economies to the oil price. So $60 to $70 would be the positive scenario, which will only happen if there's a relatively rapid resumption of flows through the Straits. That's the positive scenario. The intermediate scenario where we are right now is $90 to $100 on Brent, and the adverse scenario is $120 to $130. So we frame it in terms of the Brent price for oil because that's relatively easily recognizable to clients, but there's all sorts of complexities around downstream effects on the economies, particularly in Asia, from the general environment that we're now in. And again, at a high level, Asia is far more negatively impacted across the board than Europe or the US, which is relatively resilient. So in the intermediate scenario and the adverse scenario, the US outperforms in equities. We've been very clear on that with clients.
I mean, I think US produces about 20 million barrels of oil, consumes 20 million barrels of oil a day. Europe, of course, is dependent, and Asia perhaps a lot more, China, India, etc. Just a quick word on India, you said. I mean, India's been sideways for 2 years, is down from the highs and has underperformed generally. Jonathan, is that some buffer if the worst case plays out?
No, it's not. In terms of valuations, India is still trading at a valuation premium to the rest of Asia. And as I mentioned earlier, there are 3 markets that have a large oil and gas import dependencies to GDP: Thailand, Korea, and India. The fact that the market has underperformed is not really relevant for the situation we find ourselves in now.
So currently the base case is that Brent crude is at $90 to $100 per barrel. That's the intermediate scenario. If it were to go to the adverse scenario where Brent crude prices surge to $120, $130, is there a case for a further downgrade on India given its sensitivity?
I couldn't talk about that in a live TV
I thought you were working on various scenarios.
Yeah, obviously, we downgraded India along with other changes that we made to our markets at the first moment of what's now going on in the Gulf, and we'll continually review the situation. What I would emphasize is that it's really important not to anchor too much on base cases and to respect the wide degree of uncertainty that exists on this topic. But there are other topics as well, like AI disruption, for example, that have very profound impacts on Asia. One of the reasons that the Indian market has struggled is the outperformance of upstream semiconductor exposed markets in Asia, like Korea and Taiwan. And for the time being, the semiconductor plants, continue to function broadly as normal.
Jensen Huang said yesterday that the AI demand is exploding and he sees a $1 trillion opportunity. So at least as of now, Jonathan, no signs of peaking of the AI cycle. So Korea, Taiwan will continue to do well and attract capital from the foreign flows, because the hope was that perhaps if the AI cycle peaks out, then money will be redirected. India is sort of a hedge, a counter to the AI upcycle.
Yes, indeed. I mean, we're actually equal weight on Korea and Taiwan as well, because the valuation re-rating of some of the stocks has been dramatic. Obviously, it is not unknown that the semiconductor industry is doing well. But for the time being, whenever our team in New York comes back and looks at this in relation to AI capex, they keep on pushing up the numbers and pushing out the period before which capex might actually start to move back down again, may peak and move back down again. That's now probably a 2028 story, if that. So it's certainly part of the issue that the Indian market has faced, that you have this potential disruption downstream from some of the software services firms that exist in India, whilst the upstream area of semiconductors in Korea, Taiwan, and also Japan is doing very well.
So what do you overweight on right now and underweight on?
We have small overweights on Brazil, Japan, and Singapore.
Okay. And just to take that point on IT services in India, you think what's the thinking, Jonathan? Is there, because the debate is still on, how much disrupted, whether there's an opportunity, and how far out will that materialize? In the interim, will there be a fair bit of pain? Just your thoughts?
Well, we've been cautious on this sector for some considerable time in our regional allocations. And again, I know that it's underperformed within the market, as have some of the software and services names globally. Again, I think there's a very wide range of potential outcomes here for this sector. For now, business seems to be sort of busy. There's a lot of AI implementation projects that are underway, but obviously equity markets discount the future, and the sum of those net present values is much more uncertain than it was before.
Jonathan, I'm paraphrasing you, but correct me if I'm wrong. What you're saying is, say if this war ends tomorrow, some of the themes which worked before this war started, I mean, we basically go back to that same kind of environment, those same markets, those same trades, those same themes. Is that correct?
Yeah, so at Morgan Stanley, we have a number of core global themes. So one of them, for example, is multipolar world, which includes geopolitical risk, but also there are sectors that flow from that, like defense spending and capital goods and general industrial spending. Then there's AI and tech disruption and capex, which benefits not just semiconductors, but some of the upstream energy names, particularly in the United States itself, where the capex is significant. We do have Asia reform, things like Korea value up, Japanese corporate governance, to some extent, China SOE reform. And then we have sort of longevity, which is a fascinating theme, very playable in parts of the Asian equity market. So these are all core themes, which we've organized our thinking about for several years now.
One theme we've heard from many over the last few years is hard assets, right? And I think, I think this the shortage of oil has kind of put the focus once again on that theme. Hard assets, not just oil, but maybe a lot of other stuff, the metals, etc. But even lesser talked about things. I mean, helium, for example, is gotten discussed because of its uses in so many areas, including chips, semiconductors, etc. Is that one of the big global themes which continue to play out well, Jonathan? Hard assets?
So that's sort of linked. That's linked between sort of multipolar world and AI tech capex sort of / disruption. So again, if you think about copper, for example, that we're structurally bullish on, that's very important in data center build out, but it's also important for industrial processes generally. And then there's other metals that are involved in defense production where we have very tight supply-demand situations right now. Yeah.
Okay, got that. Just last word, gold and silver, is there a view, Jonathan?
So for the time being, gold is sort of range trading, having had a spectacular year last year. I think it's important to remember that some of the major markets for gold are arguably in somewhat of a situation where the retail investor is not able to participate right now in the Gulf. But also, again, in the case of India, and I'm not close to this on the ground, but if you're in an environment where there's increased macro uncertainty, higher energy prices, potentially higher food prices, then discretionary demand for gold may be somewhat less than we've seen before. And in fact, as a theme across our coverage, we've removed almost all of our consumer discretionary stocks at this point. So we have been making that move more to energy materials and telcos. But gold is certainly a solid hold, let's put it that way, at the moment in the portfolio.
Jonathan, just one last question. In India, and those who are watching you, those perhaps who are focused on India and not around the world who can't, how should they think about this? Now, there is AI, so maybe focus on things which can't be coded away. Again, I come back to hard assets and real physical assets, things like, I don't know, hospitals and infrastructure or...
Defensive franchises, yeah. So to be specific, we have 3 India stocks remaining in our emerging markets focus list: Reliance Industries, ICICI Bank, and Bharti Airtel. So those 3 represent what we view as a sort of a core holding in India currently.
ICICI Bank, Reliance Industries, and Bharti Airtel. These are 3 Indian stocks in the MSCI.
Our global emerging market focus list. Yeah.
Okay.
And Maruti, you're recently downgraded. Do you want to take us through that?
I can't comment on that.
Okay. All right. I think we'll leave it there, Jonathan. Appreciate you coming on.
Very much. Thanks for having me on. Thank you.
Thank you for joining us.
Bye-bye.
All right, well, that's Morgan Stanley's view, and coming in from their top emerging market strategist. We'll take a break. We are back in just a bit, and we have the management of J.K. Simmons joining us to talk about the impact of course, the Iran war and whether there's supply disruption, what's happening with prices. Anuj Khandelwal coming up next.
Welcome back. This is Corporate Radar. Let's welcome Anuj Khandelwal, the business head, JK Cement, who joins us on the show. Hi, Anuj. Thanks a lot for joining in. Coming to you in just a bit. For the time being, just highlighting the 3 top discussion points that we're looking at. What's the impact of the Iran war on the input cost? What about cement price hikes? How much is needed to offset this current raw material price inflation? And what about demand on ground? It was supposedly good. Is it as strong? Anuj, thanks a lot for joining in. First, let's focus on the raw material basket. Could you tell us how much of your mix is towards petcoke, how much of it is towards coal, and within coal, how much is imported and how much do you get domestically? Please go ahead.
Okay, Nigel, firstly, many thanks for having me on the segment. Quite interesting times, to say the least. Basically, in our basket, look, it depends across regions. In southern region, around 75% of our fuel requirement comes from petcoke. In the central region, 90% actually comes from Indian coal. So it's quite varied. And in north, it's around 65 to 70% comes from petcoke, while 10-15% comes from Indian coal. So it's a wide variety across the regions, depending on where we have Indian coal supply, where we are dependent on imports.
Okay, all right. And this higher raw material cost will start hurting you from when? What I mean is, you normally would be sitting on some inventory, right? So you would get some benefit of lower cost raw material for at least Q4. Would that be fair to estimate? And from when does it start hitting? Second half of the first quarter, or will it be in the second quarter of next fiscal?
Yeah, so basically, yes, Q4 will not have that impact because you rightly said that, everyone does carry inventories and in the current scenario, they do seem lower cost inventories for sure. Basically, it will start impacting us from second half of the first quarter, give or take, and it will depend plant by plant and it will depend player by player. But we will see the impact of higher fuel costs coming in sometime from mid-May to mid-June, depending on which player has how much stock of old prices left.
All right. There's a rough estimate that's coming from an MK note that I'm looking at, and various other brokerages as well have written. They are saying at current cost, the way the spike up you've seen in petcoke as well as coal, the cost basket could go up around 200 rupees per ton. Would that be a fair estimate, assuming that they stay at these elevated levels?
If you are looking at the current fuel cost as a barometer to judge it, the cost on the fuel side will increase by around 125 to 200 rupee per ton for various players, depending on the region they operate in, depending on the kind of product mix they operate with.
Okay.
So on an average, the industry will have a hit of 150 rupee per ton just on fuel. In addition, we are also seeing a short-term impact on bags cost, which is around 100 rupees per ton or so. So overall, I would say that the cost impact, if we just take today's prices of various materials, will be around 225 to 250 rupee per ton.
That is fuel as well as bags together.
Yes, and of course,
by bags, I'm assuming it's polypropylene bags, the PP bags, is it?
Yes, absolutely. Polypropylene is the inherent material for the bags, and it comes from refineries. And we have, for obvious reasons, prioritized gas production, right? LNG. So basically, from that perspective, the production of polypropylene does get deprioritized, which causes a bit of a shortage in the markets, which is driving the prices up. So as of now, the bags cost is also 100 rupee per ton up. So that we'll have to see how long the impact is. But if you take the fuel and the bags cost both combined, it'll average hit us by 225 to 250 rupee per ton.
And availability of the PP bags are there? Or availability is also an issue?
Yeah, it's challenging. There's no two ways about it. It's challenging, but I think we are still getting supplies so far, but we have to keep an eye out on how things pan out in future.
All right, Anuj, let's talk about demand. Y'all were bracing for a very good quarter. I understand that in northern as well as central India, demand was strong actually, January as well as February. And there has been some softness in March. So could you help us out with how our demand trends been? And in March, how soft is it in comparison to the previous month? And given that sort of a backdrop, can you push through price increases since raw material costs have moved up?
Okay, let me take the easier question first, which is the demand.
Yeah.
Right. Look, December was bumper, truly bumper. We had not even expected that kind of December. Jan, Feb were also quite robust, and on a pan-India basis and even region-wide, I would say the industry would have grown by 8 to 10%. March, to start with, is soft simply because we had, the timing of Holi between this year and the last year has been different. Having said that, I still believe that in March this year, the industry will end up at a growth rate of 5% or so, which is still, I would say, robust because last March was really good. So as far as I think, the Q4 demand for the industry will end up at around 7 to 8% or so versus Q4 of last year, which I believe is quite strong and good, given how good the last Q4 was.
Okay.
So at present, slight softness seen in demand, but not so much to worry at present. So overall, but in Q4, the demand, I would rate as being quite good.
All right, yeah, on a high base, it's pretty good. 7 to 8% growth is what you're talking about. Just a quick question. Have you all scaled back production a little bit? Or are you all going as much as you all would have liked to, or as much as you all were, say, 20 days or so ago?
So basically, we've not scale back of production. We've not done because it depends on the amount of demand which is there. Demand, I would still say, is robust. We've not had a challenge so far as as demand goes.
Okay.
But you have to also remember this is March. So basically, this is what we were even expecting, that the demand would be good. So it's broadly okay. We have not scaled back on production. The numbers are quite good. But how things pan out in future is something we are keeping an eye out very actively on.
And since you wanted an easier question, what about pricing? How much higher are pricing On an average in quarter 4 in comparison to quarter 3?
So in Q4, look, non-trade prices, because that's the segment where the price volatility is far higher, and it is in a way, depending a lot on demand. I would say on non-trade per se, across regions, we've had a 10 to 15 rupee kind of a jump in Q3 versus Q4. 10 rupee should be the average. And in trade, we've hardly seen any changes. Some regions have seen 5 odd rupee changes. Some regions have remained constant. So overall, trade is 0 to 5 rupees, while non-trade is 10 to 15 rupees.
So back of an envelope calculation suggests that you have pricing benefit, you have operating leverage that will play out, and input cost should be subdued. So EBITDA per ton improves by around 150 to 200 rupees in quarter 4 in comparison to quarter 3. Is that a fair estimate?
I don't want to comment on it, because the results will be, we will be very soon entering into a silent period. So I would want to stay away from that question. But overall, various factors which you mentioned are in place.
Okay, Anuj, very quickly, I know you all have operations in UAE, you're in charge, and you have, better insight on the India operations. But given the kind of uncertainty in the Middle East, are operations functioning as normal, or has there been some kind of scale back out there? What have you heard from your counterparts there?
No, see, there are challenges as you all have heard, but we are looking at the situation very clearly and very, very carefully, and things are too fluid for me to comment on it.
All right, we'll leave it there. Thank you very much. Good luck, and we will look to speak with you soon again. Thank you. From the last time that we looked at the markets, it's a complete U-turn which we've seen. We are above yesterday's high. Yesterday's high was about 23,500, 505 or so, and we've crossed that level. Look at that. And bulk of that move has materialized in a fairly short time span. If you look at it, I think the one-way move started at about 950 or so, and we're at about what? So in the last 10 minutes, we've moved about 100 points. Not 100, maybe a little less than that, but about 60, 70 odd points or so. The low, of course, was made at about 928, which was about 23,346. 23,590 is the upper end of the channel. So let's see. That is the level we put out in the morning. Let's see if you're able to cross it. If you're able to cross it, then you perhaps are looking at 24,000 kind of levels. If you fail, then you basically are coming down once again. So not very far. We'll find out if there is enough here for the market to test those levels. That is about 23,590. Just a quick word on the IT index, which is exceptionally weak today.
Well, it's recovered. It was down 2.5%. Now it's down 1.5%. So from the lows, it's up about 1%, but still down 1.5%. Actually, the recovery is coming in the auto names. The Nifty Auto Index is right on top. It's a near 2% gain on the Nifty Auto Index, with M&M, Maruti, Eicher Motors, Bajaj Auto all gaining between 2 to 3%. Eternal has moved up smartly. That's up about 3.5%. And metals.
Incremental recovery in the market is IT.
IT. That's a 1% recovery from lows.
Auto index was strong. It has become stronger. But the IT, and let's just put the intraday up, that is where that turn has come from the day's lowest point. So about a 1% pop from the lows for the Nifty IT Services Index. Chandan Taparia is with us at Motilal Oswal Financial Services. Chandan, good morning. Good to have you here. Just a quick word on the price action as you're seeing, and where would, what are the pivots you're watching closely, and what would confirm upside or, a reversal once again here?
Yeah, good morning, Prashant and Nigel. Thanks for having me. So yesterday, Nifty formed the bottom near 23,000, witnessed some recovery led by some short covering and improvement in the put-call ratio. Today, after the opening, it's holding the key support of 23,333. So for me, the hold of 23,333 is very important, because what we noticed in last couple of days when market was declining, it never witnessed the follow-up for second days. So if 23,333 is being respected for the day, then I believe this recovery can extend some more bounce towards 23,750 to 24,000. So on intraday point of view, 23,333. For positional point of view, 23,000 could be the key support, and looking for some more bounce in the market. But we need to keep in mind that about 24,200 to 24,440, the major trend will change. But till then, we are looking for some recovery or bounce setup in the market. Now, talking about Bank Nifty, here we witness a bullish engulfing pattern on the daily chart. Major support on immediate basis at 54,000, looking for a recovery towards 55,000 to 55,555.
Okay. Any stocks, Chandan, that you'd like to bring to our notice?
Yeah, Rima, so positive on the capital market infra theme. MSEX is our first trade. We are quite positive on the same. The good part is that even after the market corrective move, the counter is holding well above 50-day exponential moving average. Major trend of the counter is positive. Longs are intact with put writing activity. Rollovers were also positive. So most of the data set, whether we talk about the technical derivatives or the quantitative, we are getting the positive stance. So recommending to buy with support of 25.50 for an upside target towards 27.20. Again, second idea, buy on BSE, resilience, positive on the capital market infra theme, recommending to buy with support of 28.60. And this time this counter can head towards 3050 kind of level. And third trading idea, that is on metal. Nifty metal index is now bottoming out. And Tata Steel is now taking support at the previous hurdle. So role reversal pattern is visible on the daily chart. And after the correction of last 2 weeks, we are witnessing some put writing and support-based buying at the counter. So one can buy with support of 186 for an upside target towards 203 levels.
Thank you very much for that. Scient DLM is a big mover today, 14% up. This is after JP Morgan upgraded the stock to an overweight, raised the target price to 400. So that stock is surging. Current market price 340. So they still see a lot more upside. The other upgrade they did was an amber, but here the gains are more muted, up to 3%. We will slip into a break on that note. On the other side, Manisha Gupta will come back and focus on commodities. Stay tuned. Welcome back. It's time for our commodity check. Manisha joins in as always, and she's watching the rise in aluminium prices today.
Well, that's just a couple of commodities that actually have continued to rise consistently. One is energy and the other is aluminium. So when you look at the prices therein, we are trading at a 4-year highs onto this one. On a monthly basis, we have gained by 12%. And for this year, it's outperforming various other commodities as well. So in last 12 months, we've seen 26% of gains come in for the aluminium prices. Interestingly, when you look at the cash trades, they are trading at a premium rather than the 3-month contracts. Well, actually, I was looking at the December 2027. That's trading at a $3,000 a ton. The current price is at around $3,500 a ton. So we're looking at these very strong premiums that the producers seems to be charging, or smelting countries seem to be charging right now in Japan, in US and Europe as well. Japan actually seems to be charging nearly $300 a ton of a premium to its Asian consumers right now. All of this really comes in after the Persian Gulf, which accounts for nearly 9% of global aluminum output, is looking or is tied in with this conflict therein. There also are reports of closure of Strait of Hormuz, interrupting a lot of shipments when it comes to aluminum as well. And there are certain reports which suggest that nearly 564,000 tons per annum of a capacity, which is 0.8% of global capacity, is in process of shutting down in West Asia there. 2 major smelters within the area, whether it's about Qatar or Bahrain, already have taken a hit and have been forced to suspend deliveries. There are a couple of smelters which also have done a force majeure out of there. If you look at Rio Tinto, that has been offering aluminum to Japanese buyers at a premium of $350 a ton therein. But the latest news, of course, comes in from Bahrain, where Bahrain's Alba, which is the world's largest single-site producer, has shut 3 production lines there, which together accounts for nearly 19% of its capacity, which, by the way, is at around 1.6 million tons. So those are the kind of shutdowns, the huge ones that we are looking at in the international markets. Apart from Middle East as well, it is about China, which is the world's largest aluminum producer. Well, there are concerns of production into this one as well. The government has put a curb of 45 million tons, which China hit in the previous year itself. So China perhaps is not looking at any more production growth going forward. We actually could be looking at a decline to curb overcapacity is what seems to have been bothering the markets in any case. LME inventories, when you look at that, those have continued to decline in London and in Shanghai as well. An interesting report from ING says that the supply shortfall for 2026 is estimated at around 600,000 tons right now. So apart from Middle East as well, aluminum had been doing quite well. This just adds further premium in case of prices there. Take a look at Indonesia, which is also a high in case of smelting, but they also are struggling to build new plants due to high energy costs and, of course, local regulations as well. The production challenges in Mozambique also have been supporting the aluminum prices. When you look at the various reports on where the aluminum prices could go from here, well, that's a lot of bullishness continuing. We are trading at around $3,500 a ton right now. Citi says that $3,600 is their near came base scenario, but $4,000 is what they're talking about in a very bull case scenario as well. It's a similar report that has come in from Goldman Sachs as well. $3,600 is what they are dealing with if the production in West Asia is lost for more than a month. A latest report from Morgan Stanley also has come, and they also say that their base case scenario when it comes to aluminum stands at $3,700. Not too far away. It's $200 away from where we are trading right now. So aluminum continues to be an outperformer on a week-on-week, month-on-month and year-on-year basis.
Right, Manisha, thank you very much for that. Well, it's commodities in focus. More later. We are going to take a break. We are back on the other side in a special Indianomics program. Lata discusses why the IDBI divestment is flopping with former RBI Deputy Governor S.S. Mundra, former Bain Senior Partner Harshvardhan, and founder of Neostrat Advisors Abhizar Devanji. Conversation follows in just a bit.